Okay, so some of you may know, because IG has had to evolve, they are not just spread betting company anymore, they're actually a stockbroking company as well, and they offer ISAs, and they're now doing some sort of fund management as well. But as I say, I'm not here to sponsor IG. They are one of the better spread betting companies and been around a long time, and Chris uses them as well. So easy to follow, exchange traded funds. It gives you international exposure. Say, for instance, we want to get exposure to Japanese shares. For instance, I own Japan Tobacco. It's not an easy stock for you to buy, a Japanese stock. However, you could buy an ETF which tracks the Japanese stock market. It's, as I say, easier to trade than the commodity. A lot of the time now, I look at the GLD or the SLV instead of actual silver, so I look at the ETF. You can also trade some currencies via ETFs, and when Jeff speaks earlier, he's going to talk about seasonality on some currency shares. It's an easy way to cover a sector. So if you've got a small account and you want to cover Apple, you want to cover Amazon, Alphabet, and the technology or the biotech sector, for instance, instead of you just being able to buy one or two stocks, you can buy an exchange-traded fund, boom, you've covered the whole market. You can also have options, puts and calls on ETFs. So it's not necessarily, it is good for a longer-term product, but you can also trade it shorter term as well. But it's a vehicle. That's the easiest way to put it, a wrapper. It's a great tool. For the guys in Europe, obviously they use CFDs. You know, no problem to use CFDs. There are things called inverse ETFs, which I'm not a big fan of because some of the compounding doesn't work. But an inverse ETF, if the market goes down, the inverse, as it says, goes up. Now, in the past, I've been a little bit careful with the leveraged ETFs, but we've done very, very well the last year or so. We've been using something called TQQQ. Anyone bought TQQQ here before? A few of you. So what TQQ is the QQQ, which is the 100, the NASDAQ 100, but leveraged 300. At the moment, you can only go 3 times in the States. There could be talk about going to 500, but at the moment it's 3. So what that means is, if the QQQ or the NASDAQ moves 1%, this will move 3%. Now, before you say, why doesn't everybody buy the TQQ? Well, it's lovely when it goes your way, but when it goes against you, you obviously lose 3% for every 1% move. And then if you lose 3% today, what happens tomorrow? You've got to gain more than 3% just to break even. So everything's got a cost in this business. But that's where, you know, obviously leveraged ETFs can help your money go further. But of course, if it's choppy, they can start not looking so good. But the plain ETFs, when I very, very first started teaching, I was a big fan of ETFs. I still am, but I don't believe they're the be-end and end-all of everything. It's interesting, I'm now becoming a bit of a contrarian. But we started off with the DIA, the diamonds, the spiders, and the cubes, the QQQ. Obviously, costs are lower. Not all ETF costs are 0.06. Normally, the easier the ETF is to manage, the lower the ETF. Some of them are near the 1% mark, 0.95%. But on the whole, costs are lower, certainly in those insurance type of products and those branded products. And again, great diversification, ideal for small and large investors, lots of information. All right, so this is off FinViz. I love FinViz. It's one of my favorite sites. And you can, I just use the free account. The only thing I use, which I guess I shouldn't say, I use an ad blocker. So I'm still old school. I still use Firefox, and I use the ad blocker. I can't remember what, ad blocker plus or whatever. So I don't see any adverts. So I've just got the free site with an ad blocker, so it stops all the ads. All right, so what have we got here? Well, the more green it is, the more it's gone up. But this should just give you an idea of the last 12 months, and it gives you an idea of ETFs. And as I say, you can just type any of these codes into Google and find out what that ETF is. Now, after a while, you'll get to know them. VTI, which is the one I've been talking about. SPY is obviously the S&P 500. QQQ is the 100. Dow is the DIA. And then you see the leveraged ones, the TQQ, which you might find it hard to read. The TQQ is up 70% in the last 12 months. Now, it doesn't always track 3 times as much the index, because there can be errors, but normally if the QQQ is up 22, look at the QQQ is up 22, then that should actually be up 3 times. It's actually done a slightly better than the QQQ. So it's done 3 times and a little bit more. So there are 10 main sectors in the S&P 500. So if you imagine most losing clients trade indices, and in the UK the most popular bets are FTSE 100 and the Dow. Even though the Dow is not the proper representation of America, the S&P 500 is a better representation. Most people trade the FTSE and the Dow. What that should tell you, that if you're thinking of trading those markets, you're probably going to join the losers. But what the sectors do, and they changed it actually because the financials split into another one, well, when I say recently, it could have been a couple of years ago now. These are the main sectors. So all the healthcare stocks live in the healthcare. All the technology stocks live in the technology. But what you can do, you can pairs trade. So we're starting to get a little bit more advanced here. Yeah, I've taken you from baby steps this morning. Now we're going to start talking a little bit more advanced. So a pair is we could be long the S&P 500 as, and I've actually done this pair, and short the XLE. Anyone know what the XLE is? You've got it in front of you. Energy. All right. So if I see the energy sector is weak, and the system has got a sell signal, yet the SPY, the S&P is still long, I can be long the S&P 500 and short the XLE. And what that does, it takes out all the energy out of my S&P 500 stock. I can also go overweight a sector. So if I've got a buy signal on the XLK, which is the technology sector, and I'm long the S&P 500, I can up my weight more to technology. So I can go overweight a sector, or I could short and strip a sector out. So if I've got a weak sector, and as XLE is weak when I did this snapshot, I would then increase my gains. So I'll be long the S&P 500, except all the energy stocks in the S&P 500. This is a relatively new ETF that I haven't seen much advertising for or any hype for. It's by Goldman Sachs. Do you remember we used to follow something called the VIP, the very important position list? So Goldman Sachs goes through all the hedge funds and it looks for what the hedge fund's most important positions are. They've actually done an ETF of it now, and it's called GVIP. So it's a way to actually trade that. Not a bad management fee, 0.45. They're probably not pushing it too much because they don't want the clients to buy it. Because you can just buy this through Schwab at $4.95, and you could actually trade the VIP list very, very cheaply.